Governor of the Central Bank of Nigeria, Gordon Emefiele, has counseled central bankers and regulators throughout the world to be watchful and take precautions to prevent financial institution failures in their areas of responsibility. The warning came after regulators shut down the New York-based Signature Bank on Sunday, 2 days after they shut down the Silicon Valley Bank in a failure that left billions in depositors stranded. Due to this, Emefiele advised African financial sector regulators and governors of central banks to strengthen their supervisory roles in order to prevent any run on financial institutions in their countries when he spoke at the opening of the 2023 African Central Bank Conference at the Global Leadership Center in Johannesburg, South Africa.
Talking about what has happened or what is happening today globally, I think it's important for me to cast our minds back to the COVID era. COVID did create a lot of devastation to lives and livelihood globally. And after COVID, we started to see the global economy developing again. Growth was beginning to improve. Inflation numbers were good. Financial market conditions were beginning to get better. And suddenly, in 2022, another crisis came. Before then, of course, COVID created recession in very many countries, and I'm sure there's hardly any economy in the world that did not witness a recession between 2020 and 2021. But we did come out of it. But unfortunately, again, in 2022, another crisis came up, and the crisis which we're still facing today is a war between Russia and Ukraine. That has unfortunately created problems for the global economy. All the forecasts that had been made by the IMF, World Bank, and other institutions began to go south. Growth began to go down. Inflationary pressures began to climb. And of course, inflation globally attained unprecedented levels. And of course, central bankers and the Feds thinks that, well, inflation being a primary mandate of monetary policy must be dealt with squarely. So in the course of 2022, practically all economists or all Fed chairs and central bank monetary policy authorities embarked on a regime of tightening, and those tightening conditions led to interest rates going up, and without any apologies, you could easily predict that interest rates would go up, and as long as the need still is there for you to combat inflationary pressure, which also has its own adverse consequences on growth. So as a result of interest rates going up, financial market conditions globally became very tight and worsened. And unfortunately, you could see a situation where you are trying to solve a problem in a country like the United States. You're trying to solve a problem of how to combat inflation. That, of course, it now has dovetailed into banking crisis in the United States, where only last week we saw that the Silicon Valley Bank has had to come down, Signature Bank down. Of course, before then, we've seen crypto exchanges or crypto companies also coming down and all that. In Nigeria, we have come very hard on cryptos, and we do not allow both people and exchanges to use the Nigerian banking system to conduct crypto business, because we believe that as long as you believe that you want to encrypt your transaction between you and another person, and us being bankers, we want to ensure that whatever transaction is going on between you and another person is decrypted for us to know what is happening. So in case there's a problem, we're able to. So that's where we stand in Nigeria, and we have no apologies for that till now. So we've seen the risk crystallizing. During the pre-COVID era, we saw interest rates at low levels. We saw monetary policy accommodation. And as a result of that, banks like Silicon Valley that were in a long period of low interest rate regime began to invest, because in their portfolios, I'm not sure we saw large loans there, began to invest short-term funds, depositors' funds, in long-term investments. And because monetary policy became tight and unaccommodative, they began to see some losses in their mark-to-market issues. And of course, interest rates also went up. Because interest rates went up, depositors who needed to also access liquidity to meet interest rate or lending interest rate payment obligations, of course, started to withdraw money. In the course of withdrawing their monies, SVB started to liquidate some of those investments, and of course got to a point where it could no longer meet those deposit obligations, and that's where we are, where we are today. So the big question to the central banker is, really, we know why banks collapse, and how come monetary authorities have not taken the pain to take regulatory measures to avoid this kind of situations? Another question is, because the major, when you say why do banks collapse, I say a major reason that contribute to bank failures is when the bank is unable to meet its depositors' demand or deposit obligations for their monies. This usually results in a run, and the central bank, the South African Reserve Bank governor did talk about, run has been a lifelong or decade-long discussions in the midst of central bankers about what happens. But the problem is that central bankers, do we really take actions, regulatory actions that should mitigate, not entirely eliminate runs, that is reduce the incidence of runs in our banking systems so as to reduce some of the systemic crises that we see. So if a bank collapses due to a run, why is it difficult for regulators to put in place regulations that will insulate the banking system from bank collapse? In 2008, when we saw the subprime crisis and the mortgage in 2008, that was the period when we saw Lehman Brothers, Bear Stearns, Washington Mutual came down. In fact, we're beginning to see that the risk of that contagion was beginning to get even the banks like the likes of Bank of America, the Citibank, the Wells Fargo banks, and the rest of them, until the Obama administration came up to begin to give them money for them to run their operations. And luckily, within a couple of years, they were able to get out of those problems, and they paid back those monies back to government. And I was sharing some information with Sims when we had the 15 minutes break. Then in 2008, I was still the CEO of Zenith Bank. And I took time to look at the balance sheet of Citibank, I think Citibank London. In that balance sheet, and if you can go through even if you Google and you check the 5-year summary of Citibank London, you will find there that deposits plus what they call, deposit in 2008 was just about $774 billion. In 2007, it was slightly lower than that. Loans plus trading assets in the balance sheet of Citibank in 2008 was about $1 trillion naira, $1 trillion dollars. And in 2007, it was almost $1.3 trillion. So to regulators, is it safe for depositors that a bank has a deposit of $775 billion and loans and trading assets was over $1 trillion. What are regulators doing? How did regulators prepare themselves for this kind of crisis, what I call a rainy day, the day it begins to rain? What umbrella how have you built an umbrella to ensure that depositors don't face the risk of losing their deposits? I think that must be a lesson to regulators globally. And I was watching CNN and I saw President Biden came up and said, look, we need to now strengthen regulations. We need to talk about how to protect depositors and the rest of them, because that is the reason he's had to come up to say, look, all depositors will not lose their money. They're going to be paid even if you have deposits above $250,000 with SVB or with any of those banks. What are regulators doing about this? In Nigeria, people have always said that Nigerian banking system appears to be one of the most regulated, in fact, stringently regulated banking system. And I'm sure people like Yinka Sani, who has been CEO in Nigeria now, Group CEO of Stanbic IBTC, they know what we're talking about.